Welcome back to the channel. I'm Jacob Fisher, and today we're getting into dividend investing, kind of just the basics for the beginners, things like how much dividend yield should I look for, what dividend yield should I avoid, how often do I get dividends, what are the tax implications of dividends, it's just the whole thing about dividends. So let's just get right into it. Let's first go over that dividend growth versus yield, or what you should look for in a company's dividend yield with potential for growth. There are a ton of high percentage dividend companies that offer around a 10% or more dividend yield, which sounds honestly incredibly rewarding. This is the mistake though that I first made when trying to get into dividend investing. I looked at that, I was like, 10%? I want to get 10% on my portfolio value that I have in the company. That sounds amazing. An easy 10% per year. I mean, some stocks don't even go up 10%, well, most stocks do, but anyway, the trouble with 10% or super high yield companies is the cash value of your position generally drops over time. Let's say in the beginning you put $1,000 into account or into a stock, and then you get $100 back at the end of the year. Trouble is, in 5 years, your $1,000 portfolio is going to be worth $800, and you're only going to be getting $80 in dividends. So it doesn't necessarily make sense to continue to invest in them if the value of your stock is continually dropping. This also brings taxes into play because some dividends are taxed at your normal income rate. Well, we'll get into what makes a qualified dividend later for a lower tax rate, up to 0 or down to 0. But in the beginning, you might be taxed more by making more in dividends. This isn't the largest concern because you will eventually be taxed on your capital gains if you sell your position, if the stock goes up, right? So you're gonna be taxed no matter what. But those long-term capital gains are also taxed at a lower rate. Let's bring it back to those high yield companies for a second. If there are companies offering really high dividends, then they're using all the available cash that they have in reserve to pay investors, which sounds great. I want to be paid as an investor in a company. The company's paying me. That sounds incredible, right? However, that's a double-edged sword because they're not putting the money back into the company to invest in growth or just expanding. Since the company is using its available cash to pay us, the investor, or you, the investor, is not using the cash to just reinvest back in the company. Let's use a pretty famous dividend stock company, AT&T, which since 1984, they have grown 454% just in stock value and offer around a 7% dividend yield. That's a really hefty yield and a good amount of growth. It's good. But since 2000, the year 2000, AT&T has dropped 40% in value. And since 2003, because a lot of things, .com bubble. So if we go past that, in 2003, they have only increased 20% in value. AT&T is a solid company, especially for the dividends, but they aren't really increasing much in value much anymore. It's kind of disappointing. This is just the issue with companies offering high dividends. Let's take a look at Verizon, a competitor to AT&T, I'm sure we all know. Since 2000, they have seen more growth and they offer a lower 4% dividend yield. They're just keeping more cash to allow for more growth and more cash in the bank compared to AT&T. You can see a company's cash in the bank or cash on about that company by checking out their earnings report. That's a solid way to judge if a company is using way too much cash for dividends or if it's saving some for growth. Let's take a look at Apple's balance sheet, which Apple has a lot of cash. You can see through the years that Apple's cash reserve has been steadily increasing, and they have a ton of cash. They could open a bank. They could do whatever they wanted. People would probably do it, or they could start a car. Create a car. If we look at AT&T, for some reason they're not totally filled in, disappointing, but they have a lot less in cash than Apple in years prior. AT&T still has a ton of cash, so it makes them an okay company. But if we're going to look at FRO with an insane dividend yield of 24%, they don't have nearly as much cash in the bank as other companies, which is unfortunate for them, despite the 24% yield sounding incredible to an investor. This company, FRO, essentially just kind of transports crude oil because it's a shipping company. They actually have a decent $1.4 billion in market cap, but they've also decreased significantly in value over the last 20 years, going from a high of $300 to now $8 a share. While they do have cash, they also have nearly the same amounts of liabilities as assets. I mean, that could be due to the ships decreasing, there's probably more about this company, but it's important to consider finding a company that has enough cash to cover its debt if worse comes to worst and they need to pay off that debt. That sort of defines what a healthy company is, if they have more cash than liabilities or assets and liabilities, but more so when it comes to high dividend names. If a company has a 20% dividend yield but cannot cover its debt with the cash, then it's much worse than a company with high debt and no dividends, because they are focusing on growing the company by taking on more debt. At least generally that's kind of how it goes. It's super basic business economics, but there's more to it than that. There are a bit more complexities again, but you can consider kind of looking at Dividend Aristocrats if you want to keep it simple. That way, you know that they are trustworthy companies. Dividend Aristocrats are companies that have increased dividends over the last 25 years. So they've been around a while, you got that kind of checked off, and they've increased dividends. They have a market cap of at least $3 billion. So again, a notable company, and they have an average daily trading volume of 5 million. So they aren't just some kind of random companies out there on the stock market. If a company has is a dividend aristocrat, then chances are they will continue to be around for many years to come. Generally, of course, things change all the time in the stock market, but that's a good way to look at it to see if a company is something you should invest in. Let's move into what you should do with your dividends once you get them from the company. And this can honestly just be broken down super simple in two ways, and it depends on what you want to do with those dividends. Are you looking to live off your dividends? Do you need them to pay things like rent and food and other things? Is it your source of income? Because if so, you should definitely be taking those dividends out of the portfolio and using them for that. However, if you're just growing your portfolio, you're starting out, you have a job, and you don't need dividends to pay for your life expenses, then why not just reinvest them to go back in the company and back in for more growth in the future? Eventually, I'd like to live off my dividends, but currently, I don't need them. I have a job, and I don't need my dividends. So they just get reinvested back in and hopefully provide for more growth later on. Finally, for those looking to hold their dividends for a long time, will probably be taxed at a lower rate because of qualified dividends. To get qualified dividends, you need to receive dividends from a US corporation or qualifying foreign entity. It is a dividend according to the IRS, and you held the security for long enough, meaning you've generally held the security for about 121 days or 60 days. 60 to 121 days is kind of the cutoff for that, and that means that you could be paying up to 0% on your taxes for those dividends if they're your primary source of income and it's less than 40K per year. If they're not qualified dividends though, they will be taxed at your normal income rate. So it just depends on, what income you make. Let me know if you've got any thoughts or questions on the dividends in the comments below, and if this answered anything about dividend investing for you. I upload videos on Monday and Friday on travel and finance, so if that sounds like something interesting to you, hit that little subscribe button down there. Thank you so much for watching, and until next time.